You were taught the stock market is a giant voting machine that prices in all known information. So here's a number that shouldn't be possible. Research finds that for every $1 that flows into stocks, the market's total value rises by about 5. Not $1, 5. And where those other $4 come from rewrites how you think prices are actually set. The usual story online is that markets are perfectly rational, or that they're secretly rigged. The truth is stranger and far more useful. It's about plumbing. Today, why the market's biggest buyers almost never sell, why that makes prices swing far more than the news, and what it means for how you watch your own money. This is not financial advice, and it isn't a way to trade. It's a lens that makes a scary market day far less mysterious. Let's get into it. Start with the market you were taught, because the surprise only lands once you see the textbook version clearly. The textbook says a stock is worth the cash it will pay you over time. Its future cash flows, discounted back to today. Price equals fundamentals. We even talk this way. We say the market already priced it in. The phrase itself assumes prices update instantly and perfectly, from facts alone. Benjamin Graham had a famous line for this. In the short run, the market is a voting machine, but in the long run, it's a weighing machine. The whole textbook bet is that the weighing always wins. The formal version is the efficient market hypothesis. Eugene Fama put it in one line. For 50 years, that was the bedrock of modern investing. Prices are wise. The crowd is right. Your job is just to buy the whole haystack and wait. Under that view, money is just a messenger. Put $1 into stocks and the market's value should rise by about $1. Flexible sellers step in to absorb it. $1 in, $1 out. If that were the whole story, prices would be calm. They'd only move when the facts moved. But they don't. They move far, far more. And a Nobel laureate proved it 40 years ago. If prices only tracked fundamentals, they'd be steady. Instead, they're wild. And that gap is one of finance's oldest unsolved puzzles. In 1981, Robert Shiller compared a century of stock prices to the dividends underneath them. From 1871 onward, the prices zigzagged violently. The dividends barely moved. Look at the gap. The smooth line is what the businesses underneath actually did. The jagged one is the price. If prices only tracked value, those two would hug. Instead, they barely rhyme. And it wasn't a one-off. The same pattern shows up across decades and across countries. Prices that lurch around far more than the dividends, earnings, or growth beneath them ever did. His conclusion was staggering. Stock prices were 5 to 13 times more volatile than the actual dividends could ever justify. The market was moving for reasons that had nothing to do with the facts. And it's not just a century-old chart. Studying the market minute by minute, researchers later found the same fingerprint. On a typical day, about half of the market's moves trace back to order flow, not news. This became the excess volatility puzzle, and it helped earn Shiller a Nobel Prize. For decades, nobody could fully explain it. It's not a fringe finding. Economists rank his paper among the 20 most important in the journal's 100-year history. Economists tried everything to explain it, risk, psychology, bubbles. But a newer idea says the answer was never about emotions. It's about plumbing, who is actually buying, and whether they're allowed to say no. To see it, you need one idea from economics, elasticity, and one fact about who owns the market now. Elasticity just means how much does the price have to move to change people's minds. In an elastic market, a flood of buyers barely moves the price. In an inelastic one, even a small push moves it a lot. Economists put a number on it. The market's elasticity is about 0.2. A 5% jump in price only scares off 1% of demand. The market barely flinches. Picture a street where almost nobody ever puts their house up for sale. One determined buyer shows up and prices don't nudge. They jump. A market with no sellers is a market that moves on the slightest push. Now the fact, the biggest buyers today don't price shop. Index funds have gone from 19% of US fund assets in 2010 to 51% in 2024. Most of the money is now on autopilot. Think about what that shift means. Every dollar that moves from a stock picker to an index fund is a dollar that will never again ask, is this too expensive? The buyers who push back on price are quietly draining away. And here's the key. An index fund never decides a stock is too expensive and sells. It must stay fully invested. Pensions and insurers hold equities in fixed bands. They buy at almost any price and they almost never sell. An insurer holding stocks to back your pension can't just dump them because the market looks frothy. Its rules won't allow it. Multiply that across trillions of dollars and the market's natural brakes are mostly gone. In 2024, for the first time ever, more money sat in passive funds than active ones. About $16 trillion on autopilot. Pension funds show the same drift. Their equity share creeps up slowly, from 19% in 2008 to 29% in 2024, set by policy, not by price. And the real number is bigger than it looks. Once you count everything that tracks an index, true passive ownership of the US stock market is about a third, double the headline figure. The price-sensitive buyers who used to absorb shocks are disappearing. So what happens when relentless price-blind buyers meet a market where almost nobody wants to sell? Two economists finally put a number on it. In 2021, Xavier Gabayek and Ralph Koijin measured it. They're finding every $1 that flows into stocks pushes the market's total value up by about $5. Sit with how strange that is. You buy $1 of an index fund. To get your dollar in, the price has to rise until someone is finally willing to sell. And because almost no one is, it keeps climbing. $4 extra of value conjured by $1 of demand. How do you even prove that? They hunted for flows that had nothing to do with news, one big investor's quirk, not a headline, and watched what those pure flows did to prices. Their estimates ranged from $3 to $8, with 5 as the round number. Set that against the textbook's $1. The real market is about 5 times more sensitive to flows than theory says. So the market isn't a perfect scale weighing every fact. It's more like a narrow doorway. How many people are trying to get through matters as much as why they're moving. Put another way, a 1% inflow into stocks lifts the whole market by about 5%. The market is roughly 100 times more inelastic than the textbook predicts, and it held up. The results stayed near 5 to 1 across every dataset they tried. The gap from standard models isn't a rounding error, it's a different universe. The clever part was the proof. They found moments when a giant fund had to buy or sell for reasons of its own, a reshuffle, a rule, nothing to do with the news, pure flow, and every time the price moved about 5 times the size of the trade. And that may finally crack Shiller's puzzle. If tiny flows move prices 5 to 1, prices will swing far more than fundamentals ever could. Decades of supposedly irrational, random market swings, suddenly looking a lot more mechanical. In their model, flows explain the vast majority of the market's swings, close to 90% of the variance, leaving the news a surprisingly small role. A number as clean as 5 to 1 deserves real skepticism. So here's everything that should make you cautious. First, it's a hypothesis, not a law. The exact multiplier and the method are actively debated by economists. 5 is an estimate, not a constant. Some economists argue the true multiplier is smaller, maybe closer to 3 than 5. But sit with that for a second. Even 3 is triple what the textbook says is possible. Second, it cuts both ways. The same inelasticity that turns $1 of buying into $5 of gains turns selling into $5 of losses. On the way down, the multiplier is just as brutal. Third, and most important, this explains why moves are big. It does not tell you when or which way flows will turn. It's an explanation, not a market timing signal. And front-running flows is its own losing game. And it does not argue against owning the market. Broad, low-cost, diversified investing still works over time. This just explains the texture of the ride, not the destination. And fundamentals haven't vanished. Over years, earnings still anchor prices. Flows rule the days and the months. Value still rules the decades. So no, this is not a reason to abandon index funds. If anything, it's the opposite. A reason to understand the strange, powerful machine you're already part of every single time you get paid. So what do you actually do with this? Nothing dramatic. You just get to see the market more clearly. From now on, picture 2 forces setting prices. The fundamentals you read about, and the flows you don't see. Most days, the flows are quietly doing the heavy lifting. So when the market drops 5% on no real news, you have a better explanation. It may not be panic about the future. It may simply be someone large who had to sell into a market with no one to catch it. It's why a market can fall hard on a quiet news day and then snap back just as fast. A big seller emptied the doorway, and then the relentless monthly inflows from paychecks and retirement accounts quietly filled it back in. It also explains why the biggest stocks keep getting bigger. As their prices rise, their index weight rises, so the next dollar of passive money buys even more of them, a loop that feeds itself. It's also why a handful of giant companies can come to dominate an entire index. The bigger they get, the more of every new dollar they automatically receive. Not because they got better, but because they got bigger. The lesson isn't to trade the flows, it's to respect the machinery. Once you can see the plumbing, a scary day looks less like a verdict on your future and more like water moving through pipes. The next time the headlines scream and your portfolio lurches, you'll have a calmer question to ask. Is this genuinely new information? Or is it just the doorway, jammed for a moment? None of this is financial advice. It's a way to understand the ride. Stay diversified, keep your costs low, and don't mistake a flow for a fact. If this gave you a clearer view of how markets really move, follow Market Minute. Next time I'll break down where those flows come from and what can make them suddenly reverse. I'll see you there.